Welcome to Cross Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McConey, PwC's U.S. International Tax Services leader. You can follow me on Twitter at @ExporterTax. On this week's episode of Cross Border Tax Talks, I'm excited to have Chairman Dave Camp. Chairman Camp is a senior policy advisor in PwC's Washington National Tax Services practice. Before joining PwC, Chairman Camp served for over 24 years as a member of the U.S. House of Representatives, representing the 4th Congressional District of Michigan. From 2011 to 2015, he served as chairman for the House Ways and Means Committee. Chairman Camp, it is a great honor to have you on the podcast. Welcome.
Well, Doug, I'm glad to be with you. Thanks for having me.
So in doing some research, Chairman Camp, before this podcast started, I was looking for some of your latest insights on social media. And I've noticed that you have what I would call a relatively scant presence on social media, including no Twitter account. This Twitter, as you know, has turned into one of the primary policy mediums of our recent time. So I got to ask the question, why no Twitter for you? And any comments just in general on how social media has shaped U.S. politics, particularly over the last 4 or 5 years?
Well, Doug, I got caught. I think part of that is my background. You know, when I got involved in politics and public service, it was and still is in many ways a face-to-face business, but obviously technology can be a great tool. I did use social media when I was in office a bit. I didn't do it personally. My staff did it. We always did it in the third person. I never pretended that someone was writing for me. But I guess I just really prefer kind of direct contact, direct emails, calls, video chats now. It's a little harder to do face-to-face work in the COVID era. But you're right, this has really changed the political landscape. And certainly Donald Trump was the first presidential candidate to use social media and has used it extensively. Some might say too much in his time in office. But it can be, I think for an office holder, it's essential because it is one way to communicate your message. And you know that in these races, there's one side and another side, that the other side is going to be using it. So if you leave that off the field as a candidate, you're going to be less competitive. But I think there's other ways to communicate. And I've always felt when I first ran for office, everyone thought TV is everything. And I always thought it was a supplement to the other things you're doing. So I look at social media is one tool in the toolbox. Some people use it more than others, but I don't think it's the be-all and end-all necessarily. But it's certainly an important part of communicating as a policymaker and as an elected official or as someone running for office.
Yeah, as a way to just be able to have that direct contact with your constituency is just fundamentally different than anything we've ever seen. And certainly President Trump has used that more than anybody. But it really is interesting to me to see as a way that, you know, instead of going through what would be considered the traditional media to contact those constituencies or doing the town halls, it really is an amazing way to be able to reach so many individuals. So, right. I'll keep an eye out for you, Chairman Camp, so right. that I promise to be your first follower on Twitter if and when you ever decide to plunge in.
I obviously need to up my game.
Right. You that is a relatively low bar you've set for yourself at this point, Chairman Camp. So I look forward to that. All right, so let's move on to tax policy. And I have referred to you in private circles as the godfather of guilty. And this goes back to when you started with the House Ways and Means Committee in 2011. So in doing some research, I found a quote from Congressman Richard Neal, and this was back in November of 2011. So shortly after you put forth your proposal, which really seemed radical at the time, this concept of this low tax, this new category of subpart F income, which would effectively you had proposed moving to a territorial system of tax away from our worldwide tax system, but to the extent that income was subject to a relatively low amount of tax, and I believe it was 15% was what was originally thrown out there, then that income would become immediately subject to U.S. tax. And then you had also even mentioned the deduction for that type of income. And Richard Neal said at I believe the first committee hearing on this was that he had mentioned that a Chinese philosopher once said, quote, "A journey of 1,000 steps begins with the single step." And that was in November 17th, 2011. And it is amazing to me how many steps have been taken now. So 9 years later, this proposal that you put out there, it's the law of the land here in the US. We have a mountain of regulations where we have spent a lot of time here on the cross-border tax talks dissecting, acknowledging what a difficult endeavor Treasury had, as well as Congress, and putting together the architecture of these rules, and then with Treasury fine-tuning them. What we've seen now globally with BEPS 2.0 is that now this minimum tax is a potential, not just the law of the land in the US, but potentially globally. And wanted to get your thoughts and your perspectives from 9-10 years ago when this was originally thrown out publicly. And I'm sure you were talking about it before then. What are your thoughts on where this has come today and where this might be going from a global perspective?
Well, I should sort of dust off those issues from a while ago. One of the things that was driving the debate on international tax in the Congress was the fact that there was a feeling the United States was out of step with the rest of the world, and particularly our worldwide system of taxation, which you mentioned. And so part of the debate and the discussion and surrounding that was, how do we become more like the rest of the world? And obviously that involved moving toward a territorial system in terms of the discussion. But also this sense after 08 and 09, there was a considerable loss of revenue. So we felt we needed to make the United States more competitive as a place to invest and grow the economy and create jobs and help families. But also this sense that there really had been, because of the disadvantages the U.S. placed on businesses, that there was an incentive to operate in other parts of the world. So the attempts were, how do you find a way to make the U.S. A competitive place, and not only competitive, a welcoming place. And particularly what was troubling to many members is the loss of U.S. headquarters. And not that all jobs necessarily moved overseas, but the worry that then future investment and future growth and future jobs would be in other places in the world rather than in the U.S. I in my congressional district, I had a large company, 3,000 jobs leave one of my smaller communities. It was a big blow, and the concern there was a few years before, the headquarters moved from there to Atlanta, and then from Atlanta to another country, and so the thought was those jobs are generally some of the best jobs in communities, and whenever you're trying to make the fabric of a community stronger, you look to those employees to contribute to the hospital board or to contribute to United Way or help really strengthen communities. So there was a real concern, I think, among policymakers about the direction things were going. This was one way, and as you know, this is a very complex area, and the TCAJ didn't exactly follow the directions that I was trying to go, but they did move in this direction. And I think it's a tough area to refine without other issues also being on the table. I think it's very tough to just do international fixes and changes alone. That's why the regulatory process has been so important in this. But that's really the background behind that, and how we, I think, ended up where we are today.
Yeah, so any perspective at this point, and obviously still relatively early from the TCJA, I think that maybe a couple of observations as more of a practitioner and less as a policy person is that, I think behavior has changed. I think it's a combination of changes to the U.S. system. I think including the reduction of the corporate tax rate. I think some of the regulatory changes, specifically with respect to 7874, the anti-inversion rules, I think that curbed a lot of the activity that we saw with some of those potential changes to US headquarters. But I also think that the corporate rate, which was lowered as part of the TCJA, also really impacted that. I also think more from a maybe micro level that just the day-to-day decisions that VPs of tax and tax directors have to make with respect to tax structuring. So whether it's a deal, where do you put your assets? Do you put those intangibles in the US? Do you put the intangibles offshore? How do you manage that? The obviously the GILTI changes the math on that, as well as a lot of the laws outside the US that have changed. So BEPS 1.0 and then as a result of BEPS 2.0. So I think even in my, what I would like to think, relatively short career over 20 years practicing, it's been amazing to me how much stuff has changed even over the last 10 or 5 years that fundamentally change how businesses make decisions with respect to assets, deal structuring, investments, topcos, et cetera. But do you have any reflections at this point, now that at least a couple of these concepts, which I appreciate, are really borrowed from your proposals and not fully consistent with what you had proposed 8 years ago? Any reflections on how that's operating?
Well, I think particularly the one unifying issue in all of tax reform, when I was involved in it and during the time this TCJA was being debated, the corporate rate was the one unifying issue that kept everyone together. And once you get off that, obviously different sectors, different businesses have different views on almost everything else. But getting the corporate rate to 21 exceeded where I thought it could go. And obviously, though, with a 1.5 trillion in budget room, it gave them the flexibility to do that. And I think it was an important statement to make, and really I applaud the fact that they were able to get to 21. And I think that has had a big part of it. I just don't think we're done with this area. The regulatory process is a part of it, but there will continue to need to be refinements. Policymakers aren't all international tax experts, and certainly the international tax practitioners who deal with this every day can really delve deeply and in a more nuanced way. And ultimately, when you're in the legislative process, you do have to get votes, and so it can't always be perfect. But I do think this is an improvement, that we've become more competitive as a country, all in all, and that it was important to recognize that there were actions that caused companies to invest not just because markets were there, but invest simply for tax reasons in other places. And this is, I think, one way to try to address it. And so, yes, does it need more work? Is it perfect? No, but I think, and it has created a lot of complexity and a lot of work. There's no question about that.
We have certainly spent a lot of time on the cross-border tax talks, right, dealing with those complexities and the regulations. And it is just such a challenging area. It is amazing to me that people who don't do this for a full-time living, like yourself, were able to be so conversant. And because you're right, it is just so layered in complexity that it does baffle my mind how members and even their teams have to deal with this amongst all of the other complexities. And I do also have to remind myself, Chairman Camp, that the corporate tax base, or the revenues from the corporate, are just a tiny fraction of overall. And with respect to, it's the world that we live in, that I live in, but with respect to overall GDP and the amount of money that the country brings in, it's mostly driven by individual tax and not corporate tax.
Yeah, the individual tax, payroll tax, income tax. You want those high-paying, quality jobs, some of them corporate-level jobs. You want those in the U.S., and you want that company platform to be able to do business around the world.
So it's a good transition then. I've heard that there is an election right around the corner, and wanted to spend a few minutes with you talking about the Biden proposals and really understanding. He's actually put out a platform with some relatively detailed proposals for how his administration would potentially change our international taxation of corporations, as well as some individuals and capital gains, and a series of various proposals. Then wanted to spend a little bit talking about that the Republican proposals, or arguably the lack thereof, and what we might see if there is a Republican administration. But let's start with Biden, and can you provide the listeners an overview of some of the proposed changes, really focusing on the corporate aspects of the Biden proposals?
Yeah, I think probably the most significant is increasing the corporate rate to 28%. That is probably the most significant proposal that he has in terms of revenue. Probably the other unusual one, I think he really borrowed it from Elizabeth Warren, is the 15% tax on book income for large companies, those with profits of over 100 million. That will actually introduce a significant level of complexity. It's almost like bringing back the corporate AMT, which the TCJA eliminated, because it really will require a dual calculation. And as we know, a book income is a larger base than taxable income. So that is a significant proposal. And I guess some of the other items include sort of eliminating tax preferences for certain industries, particularly energy and real estate. Also, the GILTI provisions that we talked about, he doubles the GILTI tax as well. And so I think those are all things that are significant to look at. One that is not necessarily viewed directly as a business tax would be the increase in capital gains taxes to the highest individual rate, so 39.6 plus the 3.8 net investment income tax of 3.8%. So that certainly puts capital gains taxes in the low 40s, and that would make us the highest investment tax country in the world. We're already sixth in terms of OECD capital gains taxes at 20% for long-term capital gains. And the reason I think this is important to look at is all of these provisions go to the competitiveness of U.S. companies around the world. And we really do have to look not just what these mean for the bottom line. And I realize all of the Biden tax proposals raise between 3.5 and 4 trillion, depending on which analysis you look at. And that's primarily for new spending in healthcare and climate change, not in debt or deficit reduction. But all of those proposals really impact how the U.S. is viewed as a place of investment. And I think investment directly affects business and directly affects jobs and directly affects employment and all of those items. So I think it's important to know that the really significant increase in capital gains. Now, there's a question of how does this election play out? First of all, does Joe Biden win? Second of all, does he bring a Democrat Senate with him? I think it's generally thought that the House will stay Democrat under almost any scenario. But will he have then a large majority in the Senate, or will it be a narrow majority? And will some of those senators be centrist Democrats? And therefore, will he be able to get all of these items that he's proposing? But I do think it's important to know they're out there, they're on the table, they're in his plan of things to do if he's elected president, and it's important to know what they are. But those are kind of the top of line business changes. There's also a paring back of pass-through taxation. The 20% will be phased out for incomes. 20% deduction for incomes over $400,000. So you really do see in his proposals higher taxes on higher incomes, taxes on investment, and taxes on payroll as well at certain income levels, as well as some of these other business provisions that may make us out of step with the rest of the world. And that's the concern I have with some of those ideas.
One of the things, Chairman Camp, that I think will be particularly relevant for the listeners of the Cross-Border Tax Talks, as you mentioned, is the 28% corporate rate and then the proposal for the 21% rate on GILTI. One of the things that the Biden proposal was silent on was, well, what about foreign-derived intangible income? So the carrot for your stick. which is a great saying that I think you put out there into the tax vernacular almost 10 years ago. And
Right.
so it brings this fascinating question. Well, would they keep FDIIs, or foreign derived intangible income, still at 10.5, move the GILTI rate up at 21%? So there was not that continued parity. And then, and so do you have any thoughts on that? Or was that an intentional something that was left out, or knowingly and from a policy perspective? Or is this just one of these, hey, the proposed administration gives their high level proposals, and this just wasn't something that had been mentioned? But there's been a lot of speculation on, well, if they move the GILTI rate up to 21, does FDII need to follow as well?
Yeah, I don't really know the answer to that, but I will say that campaigns tend to not be as specific, and frankly, in 16, Donald Trump as a candidate had a more specific tax plan than most candidates do. So the fact that not all the details are in his ideas, in Joe Biden's ideas, isn't necessarily surprising to me. What I don't know is this was an intentional, or they don't plan to do anything. I just don't know on that. But it is, there's a lot, he has a lot of specificity on a lot of things. But that one, it's just an open question.
Yeah, I like to remind people, Chairman Camp, that Trump's original proposal was a 15% worldwide rate. So in other words, a full 15% tax on corporations for their global income. And I remember many of us thought that was just so crazy to even contemplate a full worldwide system. But that would have been obviously a relatively low rate by OECD standards. And what we ended up with was a 21% rate for corporations, and then effectively a 10.5% on non-US tax, which you average those two, it's about 15%. So it was really kind of surprising. And that's obviously one way to look at it, but it was surprising to me how relatively close what we ended up with the original Trump proposal with what got enacted, you could argue was fairly consistent. One of the other questions that I have for you with respect to potential tax reform. So I waited, Chairman Camp, my entire career for one major change in corporate tax law. I graduated law school in '99, so I finally got my change. I'm now wondering, are we going to see change again with this potential Biden proposal, and how drastic will it be relative to the existing proposal? But I think as I've studied this, we've seen as tax reform is usually, it's not typically the first year. And I think this even goes back to well before me during the Reagan administration, that it was usually a second or a third year in office where major tax changes could happen. We are certainly in unprecedented times with COVID, with the largest budget deficits that we've ever seen, and still potential more stimulus coming and additional deficits. Do you think that if Biden were to get elected, that corporate tax reform or these changes could occur sooner rather than later? Is this something that could occur earlier in the administration, even potentially the first year, as a means to either raise revenue for particular objectives that they have, or to try to cure deficits? Could this happen faster than it's maybe happened in the past?
Well, I'm not sure, because I mentioned it would really depend on the makeup. First of all, they'd have to win the Senate, but then it will really depend on the makeup, and will they win that Senate majority, if they do, with more moderate Democrats. But also, I think the economy is going to play a big role in this. If the economy has not recovered to a point, will they really be able to sustain this level of increased taxes and revenue going to the federal government out of the private sector? I think that's going to be something that's going to be important. And then lastly, sort of reading and listening and watching the tea leaves and talking to people, it does seem as though they may be leaning toward, and listening to Joe Biden's comments himself, an infrastructure or stimulus package as the first thing out of the box. So yes, while these proposals are out there, it's still unclear what priority these tax proposals may have in a Biden administration. And at least right now, it looks as though it may not be the first thing they try to do out of the block, but something with regard to infrastructure or stimulus might be the first thing. But again, in many ways, the campaigns are just getting underway. There's still a lot of campaign time left. and we'll see how the issues sort of evolve going forward. But that would be my guess. And then lastly, will it take 60 votes to enact some of these things, or will it be a simple majority? And that depends. Are they able to move some of these items through what we call the reconciliation process, and or are they going to address the legislative filibuster in some way? And those are items that could come later if, in fact, they decide to do tax reform at a later time, or these tax proposals at a later time. But there are so many of them, it is almost like a tax reform you might call it 2.0 or 3.0, because they're pretty extensive.
Yeah, I've lost count at this point. I'm not sure if it is 2.0 or 3.0, given the various iterations. So let's talk a little bit about the Republican proposals, or arguably the lack thereof. So every 4 years since 1856, so in my math, that's 164 years, there's been a formal Republican platform until this year. Now, a lot has changed between just the current administration and COVID-19. I guess my first question is this a big deal or not that the Republicans actually have a platform? I mean, do these things even really get followed? We all the policy nerds, I run through there looking for the corporate business law changes, and who knows what happens to these. They're fascinating to read. But first question, is this a big deal or not? And then secondly, what do you think that if this administration were to get reelected, what will its goals be, and what do you see the tax landscape looking like if there is a Republican administration, and presuming that the Democrats would still control the House?
Well, Doug, I think over the years, the platforms have become less important as a public document. They tend to be something that activists fight very hard for, issues behind the scenes, and policy certainly does matter. But in terms of the platform's effect on the presidential campaign, that effect has diminished significantly over the years. And the fact that there is no platform at all, I don't think really matters a whole lot. Those would be written and promptly ignored and put on a shelf and gather dust. And I mean, can any of us really? Maybe you can, but most Americans aren't going to go search out the party platforms, because what happens is once the nominee is a nominee, the platform really becomes whatever the nominee's position is anyway. And so I think they've become much less important. In terms of tax policy, certainly right now the administration's been focused on this deferral of Social Security taxes. And one of the items could be, how is that deferral dealt with? Is it forgiven? Is it a transfer from the general fund to pay for the shortfall in Social Security taxes that are collected? That doesn't seem to have a huge take up right now, but that's certainly been one of the president's key priorities. Over the time, he's talked about a number of things, even lowering the corporate rate, statutory rate to 15, as we talked a bit about before. He's talked about a middle class tax cut. Not a lot of meat on the bones on those proposals, but at least they've been things that the president's talked about. He's also talked a bit about indexing capital gains, but there seems to be a consensus, at least in the Treasury Department, that would require congressional action in order to do that. He's floated the idea of lowering the capital gains rate. I think we'll see over time what the president as a candidate lands on for the second administration. But I do think it's important to let the voters know what you're going to do if you want to be reelected. And I think both conventions sort of made the mistake of saying how bad the other one was to some extent. And I do think that one of the things that needs to happen is some articulation of what you would do as an incumbent if you're going to get reelected. And I always felt that obligation to say, why should people send me back to Congress, and what are the things I'm going to work on if I go back there? So I'm hoping we'll see more detail, but there have been a number of ideas kind of thrown out there. It's just not clear which one is at the top of the list right now.
Well, as we get more detail, we'll certainly talk about it here on Cross Border Tax Talks. Maybe I'd like to leave this with a question for you. This is something that I've had a lot of discussions and debates with, particularly our non US colleagues, and comparing our two party democratic system with parliamentary systems, particularly in Europe, but we see it elsewhere throughout the world. And maybe it's I'm an outside the beltway kind of guy from the Midwest, and have certainly learned a lot in my time in Washington working with you and many talented others on our policy teams. But one of the fundamental views that I had was the difference between our two-party system and Republicans and Democrats versus a parliamentary system where generally a government will need to seek coalition with other smaller groups to be able to put together a coalition to actually form a government and dictate policy. And I always kind of viewed our system being different than that. We had the Republicans and the Democrats. And what I've seen really since, and maybe some of this is just my naivety, that the Trump administration and the Republicans have really seemed to develop their own coalition, which is fundamentally different than at least the Republican Party that maybe I was more familiar with in the 80s and even 90s, or even more recently. Do you see any merit in that comparison? And is that really a change in fundamentally how we operate it is? Or am I just looking at, frankly, too small of a sample size, and that, parties have really continued to evolve over time, and this is just part of the way our system operates?
Oh, well, parties do evolve over time, and they do incorporate various movements that spring up that are somewhat ideologically aligned with them, and that does happen over time. And I remember in the late 70s and early 80s, actually before 80, in the 70s, when 76, when Ronald Reagan was running for president, the Reaganites were not considered part of the Republican Party, and clearly in the 80s they became the Republican Party. So these things do change. I do think that we still are fundamentally different than many European systems, in that our branches of government, our executive and our legislative, are co-equal branches of government, and our courts. And in a parliamentary system, that isn't exactly true. Now, I realize the executive has, over the years, really gained much more authority and power. Some of that delegated by Congress, and some of that because Congress hasn't exercised the kind of oversight they need to in a bipartisan way. But these things do change and evolve, but it does appear, at least as, and I've seen this over the last 20 years, the party who has the White House, their members tend to be voting with the president of their party, and less of this really being sort of freelancing and addressing issues as they come up, but more having a party position on more issues than there used to be in the past. So that has been a change. I think a pretty significant change, and the country has become more polarized over the years. So it's really harder for a legislative process, which is based on compromise, to compromise with such a polarized environment. And in the past, that was really how you got things done. It really, if you're trying to have an agreement with someone, it's very hard to have it all one way. And it's been much harder for legislators to be able to compromise, because the issues are much more. And that's, obviously financing has changed. How you fund campaigns has become much more polarized. Media has become much more polarized. And so the electorate is much more polarized. So that does impact our system significantly and make it harder to do. But things do evolve, and I will say that I know some people say, "Oh, in years past it was such a bygone era." If you read history, we've had some pretty polarized times in our country, and I do think it's still the best system, although imperfect. We at least try to have a system where people have a say. They may not always get their way, but they have a say in what happens in our representative democracy. So it's always exciting. Presidential elections are for all the marbles. It's really the Super Bowl of politics when you have a presidential election. And it's going to be fascinating to watch this one play out as well.
Well, I certainly agree and hope that the pendulum towards civility and compromise will move back. Believe in the good of people and do hope that civility and compromise will reign at some point. So why don't we leave it with that? Chairman Camp, thank you very much. It's been an absolute honor to have you on Cross Border Tax Talks.
Thanks a lot, Doug. Great to talk with you. Look forward to doing it again sometime.
Thanks for tuning in to this week's episode of Cross Border Tax Talks. A special thanks to Chairman Dave Camp, Senior Policy Leader in PwC's Washington National Tax Services Practice. I'm Doug McConey, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of Cross Border Tax Talks.